what's better than earning money from a 9-to-5 job? It's earning money while you sleep, which is made possible if you start investing. You're listening to the Real Estate Investing Demystified with your very own dynamic duo, Ava Benisaki and August Biniaz. Tune in as we discuss everything real estate, both on the passive and active sides. We feature life-changing stories of today's real estate leaders that will help build your own roadmap to success. This is a show that will lead you to a diversified portfolio, a much bigger revenue, and a next-level venture that brings you a smooth cash flow. Let's get this episode started.
Hey everybody, my name is Paul Hopkins here and I'm with Real Estate Investing Demystified, here with my good friend Anton Mattli with Peak Financial. We're here in Dallas at Brad Sumrok's real estate conference, AmNetCon. And I wanted to ask you a couple questions while we were here. The last couple years, the last 4 years have been a bit of a wild ride, and finally the Federal Reserve has lowered the interest rates. What have you seen lately with the moment that the Fed made those announcements?
It's the Fed rates are now a little below 5%, 4.75 to 5% as a guidance, right? Does that really move the needle? Not really.
Right.
However, from a psychological perspective, that has a big impact because now everyone believes now we have turned the corner. We have the grip on the inflation. We likely have a soft landing, maybe not even a recession at all. And that gives a boost to commercial real estate investors and other investors. And as of today, actually, Dow just closed at record highs, right? So obviously, whenever the Fed is lowering rates, that gives quite a boost to the investor community. Even though from a practical perspective, certainly for commercial real estate, when you are in a floating rate loan, whether you are now at 8.5% compared to roughly 8.75 or 9%, doesn't really make any difference of significance. It makes a difference, but it's not large enough, but it only has a positive impact on the sentiment.
Got it. Okay. So there's a lot more confidence that possibly is in the market now with buyers that is this now the right time for buyers to get into the market and probably sellers even to start consider selling their assets to buyers?
Well, what I would say is only if you're a buyer, if the deal makes sense and it underwrites, then go ahead, right? So there is no reason to say, well, I'm waiting for better times. And obviously we have talked about distressed assets in multifamily and other commercial real estate for quite some time. And there is still an opportunity for these distressed assets to come to the market. But just waiting for those and just waiting on the sidelines when the deal makes sense just doesn't make sense. Now, if you're a seller, I would say it depends on your situation, right? If a lot of sellers that we see today, they are essentially two categories. The ones that are not distressed, they do not have to sell, but they reach the end of their holding period, right? Whether you're a syndicator or institutional investor, typically your hold period is somewhere between 5 and 7 years. And once you reach that and you reach the returns that you intended to achieve, then you decide to sell, you turn your portfolio into other assets, maybe better returning assets, whatever it might be. So these are the investors that have the decision power, whether they want to refinance or sell today. Whereas you have the others that are more in a distressed situation, they don't really have a choice. They have to take action. And for those, I would say, do not hope for much lower fixed rate interest rates. If you have an opportunity to refinance now out of your floating rate loan, do it now rather than just hoping that fixed rates will be much lower in a year from now.
Okay, got it. Yeah, we were predicting to see a wave of distressed properties coming to market, and we were just kind of waiting on the sidelines to see that happen, and it didn't really happen, did it? And so there was a lot of high octane debt, high leverage debt, floating rate interest that were put on these properties. And now that we've kind of gone through that learning curve with a lot of operators, what are you seeing now as like the appetite for buyers, and what type of loan structures are they now committing to?
Yes, just to get back to the question of why haven't we seen more distressed sales, I would say just be patient, right? Commercial real estate, as all real estate, is slow moving, right? So when we look at the GFC, it took 4, 5, 6 years until we hit the bottom. On the residential side as well as the multifamily side, it was a little bit faster, but it takes years to really hit the bottom. Now, when it comes to these distressed sales, and I have been talking about this for quite some time, we haven't really seen a large volume of those. However, a lot of deals have been moved into, the loans have been modified, worked out, whatever you want to call it, extended. And the lenders, based on what we hear from various lenders we talk to, bridge lenders we talk to, they tend to be kind of no longer that willing to do yet another loan modification, particularly for the deal sponsors that don't have cash to bring to the table. And I would say over the next 12 to 24 months, we see much more of those distressed sales that has essentially just have been pushed out, right? So yes, a lot of us expected that already to hit in 24. I still predict that we see a much higher uptake on those. However, it's not all asset classes, and even within multifamily, it's just certain segments, right? Yeah. So it's only B and C class. We'll see those that have done a lot of bridge loan financing, they definitely have a problem. And roughly half of all the bridge loans that are out there, based on our analysis, have some form of a distress where the owners need to bring in cash to the table to refinance out of those, or have a significant capital loss, right? So in that segment, there is certainly distress, but it hasn't really hit the market yet, right? So now to the other question, obviously back then when everything was cheap, floating rate loans were cheap, fixed rate loans were cheap. Fixed rate loans still didn't work out back then in 21 because the lenders underwrote to, and that's always for permanent financing, to in-place cash flow, whereas bridge lenders underwrite to future cash flow, very aggressive projections, and you could get up to 80% LTC compared to 50% LTV on a fixed rate loan. So that was the main driver back then. Now, naturally, everyone has learned the lesson, and now everyone says, well, now we want to go with fixed rate. So it's only on the refinancing side, over the last 2 months, it has exploded. Everyone is backed up. Fannie is backed up. Freddie is backed up with refinancings. And it takes them forever just to get approvals through the system. So clearly there is a massive interest now from commercial real estate owners to refinance into fixed rate loans. So now everyone talks about, well, rates go down, rates will come down significantly. That is only true assuming that the trajectory comes along the way as what John Chang mentioned and many others are mentioning, and the market actually thinks, where we have significantly more cuts on the Fed rate, which brings the SOFR down. So anywhere between 1 to 2% over the next year and a half to 2 years. So that's very significant on the short end. That doesn't mean that the longer end of the yield curve, like the 5, 7, and 10-year Treasury yield, which are really the important indexes for fixed rate financing, that they will come down significantly. And there, I believe, there is not really that much of a movement. We already have seen those rates coming down. So eventually the yield curve will reverse from the still inverted situation we are in. And the 5 to 10-year Treasury yield will not move that significantly. And I think the smart money and investors realize that, particularly institutional, and saying, well, now we need to refinance over the next year anyhow, so now it's a good time to refinance. So now danger there obviously is that for those that have a strong belief that the 10-year Treasury and 5 to 10-year Treasury drop significantly, my question to those is, if you really believe that, with a fixed rate loan, be aware that your prepayment penalty will be significantly higher than what you think it is today, right?
Got it.
So just as a kind of a warning, we have had that already in with some loans that were in the 5% range in 2018 and 19 that then wanted to sell in 21, and because the treasury yields were so low, they could not sell the property or had to take a significant loss on the prepayment penalty side.
Got it. Okay. And now with interest rates that have dropped and there's more confidence now in the markets, do you feel that cap rates are going to come back down to where they were 4 or 5 years ago?
Definitely not. So there's clearly kind of an opinion. I have that discussion with investors and friends who are in the investment community every single day. And there is definitely that opinion that cap rates will now come down. I personally do not really see that is happening for the following reason, right? So cap rates are still pretty, when you look at the spread between the treasury yield and the cap rates, they are still really tight, right? Historically speaking. So there are really two reasons why I do not believe it. First, the spread between the treasury yield, the 10-year treasury, and the cap rates is still very tight. Okay. And at the same point, I do not believe that the treasury yield, the 10-year treasury in particular, will come down significantly. And I do not believe if the treasury yield is not dropping significantly, that somehow the cap rates are going to compress significantly, because then that also would mean that the spread between the treasury yield, 10-year treasury, and the cap rates would compress again further. Now, obviously the argument is there is so much dry powder on the side. I understand that, but I think a lot of that dry powder has learned the lesson from 21 and 22. Yes, they are out there, but they are not deploying that money unless it makes sense, right? So I don't think that that rush to buy at whatever cost is coming back, because investors have learned their lesson.
Okay. Good. That's excellent information. And so what I take from that is still underwrite to a good, healthy cap rate exit. And don't get too aggressive on your underwriting, because we never know what may happen in the next couple of years. But as long as we're smart on our exit cap and our business plan, we buy the property right and we manage it correctly, we could always win.
Yeah, definitely.
Okay. Well, great. Thank you so much for your time. And
same here.
Appreciate it, and always good to connect with you.
Yeah. Thank you.